Effective liquidity management, best practices for bank professionals. Welcome to today's video on effective liquidity management for bank professionals. Liquidity management is a crucial aspect of banking operations, ensuring sufficient funds are available to meet short-term obligations and maintain financial stability. In this video, we'll discuss some best practices that can help bank professionals optimize liquidity management strategies. Let's dive in. 1. Develop a comprehensive liquidity management framework. Start by establishing a robust liquidity management framework that outlines policies and procedures for measuring, monitoring, and managing liquidity risks. This framework should incorporate regulatory requirements and industry best practices. 2. Implement cash flow forecasting. Accurate cash flow forecasting is essential for liquidity management. By closely monitoring incoming and outgoing cash flows, banks can identify potential liquidity gaps and take proactive measures to mitigate risks. Leverage sophisticated forecasting models and technology tools to improve accuracy and automate the process. 3. Diversify funding sources. Relying on a single funding source can expose banks to liquidity risks. It's advisable to diversify funding sources by accessing various instruments, such as deposits, interbank borrowing, and capital markets. Having multiple funding options improves flexibility and reduces dependence on any single source. 4. Maintain adequate liquidity buffers. Establishing and maintaining adequate liquidity buffers is essential for managing unexpected liquidity demands. This buffer can be in the form of liquid assets, including cash, highly rated sovereign securities, and other marketable instruments. Striking the right balance between liquidity and profitability is key. 5. Stress testing and contingency planning. Conduct regular stress tests to assess the resilience of liquidity positions under adverse scenarios. This helps banks identify potential liquidity risks and develop contingency plans to address them effectively. Simulating severe market conditions can provide valuable insights and guide decision-making processes. 6. Monitor and manage market and funding liquidity risks. Stay vigilant about monitoring market and funding liquidity risks. Regularly assess the liquidity profile, funding term mismatches, and concentration risks. Stay informed about changing market conditions and potential disruptions that can impact liquidity inflows or outflows. 7. Establish strong relationship with liquidity providers. Developing strong relationships with liquidity providers, including central banks, can help banks access emergency liquidity facilities during times of stress. Understand the eligibility criteria, operational requirements, and terms of accessing these facilities to ensure preparedness in times of need. 8. Regular reporting and disclosure. Maintain transparency and regulatory compliance by regular reporting and disclosure of liquidity positions and risks. This keeps stakeholders informed about the bank's liquidity profile and risk management practices. Compliance with regulatory requirements is crucial to maintain trust and credibility. 9. Continuous monitoring and evaluation. Liquidity management is an ongoing process that requires continuous monitoring and evaluation. Regularly review and assess the effectiveness of liquidity management strategies, and make necessary adjustments based on changing market conditions and regulatory requirements. So there you have it, some best practices for effective liquidity management in the banking sector. By developing a comprehensive framework, implementing cash flow forecasting, diversifying funding sources, and taking measures to maintain adequate liquidity buffers, bank professionals can enhance their liquidity management strategies and ensure financial stability. Want to learn more? Claire Trifle on LinkedIn.